So, deductible gifts to charity as well. We talked a little bit about this at the beginning, that we've got a couple different types of charitable contributions. We've got cash and non-cash. Non-cash is a pretty broad category. Could be tangible personal property that's being contributed. It could be investments that are being contributed. When we talk about non-cash types of contributions, we have to establish what the fair market value of that item is in order to determine the value of the deduction, right? Cash is pretty easy. Cash is cash. You donate $250, it's worth $250. The non-cash stuff can be a little bit more confusing though. It is, again, it's an itemized deduction on Schedule A, so once again, you've got your total itemized deductions need to exceed your standard deduction in order to get any benefit from this. Now, first hurdle is that the contribution, whether it's cash or non-cash, has to be to a qualified nonprofit organization. So what exactly is a qualified nonprofit organization? Any governmental unit or subdivision of the U.S. or its possessions, as long as the gift is exclusively for public purposes. So somebody donates land to their city to build, have a park or something like that. Then the fair market value of that land would be a charitable deduction that they get. Any nonprofit organization that is organized and operated exclusively for religious, charitable, scientific, literary, or educational purposes, or to foster international amateur sports competition and is not disqualified from tax-exempt status under 501c3. Has anybody ever heard that term before, 501c3? 501c3 is the portion of the tax code that describes that specific type of charitable organization. Most charitable organizations are organized under that tax code. So if you hear that 501c3, that just means they're organized under that tax code, and that they are eligible. Then you can make donations to them, and those donations will be deductible. Okay. So, and sometimes you'll hear it. There are organizations that maybe advertise, and they'll say, we're a qualified 501c3 organization. That just tells you, that any donations they are a qualifying organization. Yes.
I'm sure you're gonna get to this, but is there a limit?
There are some limits. And
okay.
We'll
I figured we would, but like you said, donating land, and I'm like, okay, well, if the land's worth, $150,000, is there a limit to
Yep, we've got some great, and it depends as well on what the organization is gonna do with that property. If they're gonna sell it, or if they're gonna use it for its purposes. And we've got some great examples in here as well that we'll go through. That is a good question. I know I keep saying that. Good question. 501c3s, poster organization of war veterans for which no part of the net earnings benefits any private shareholder or individual. Think BFA, that sort of thing, or VFW, that's it. That sort of thing. Domestic fraternal society or association that uses the contribution for religious, charitable, scientific, or educational purposes. Think Lions Club, Rotary Club, that sort of thing. Cemetery company owned and operated exclusively for the benefit of its members. You could be a member of a cemetery company. Those are, and it's pretty limited. You cannot give donations to individuals and have it be tax deductible. So if you're driving down the street and somebody's out in the middle of the intersection asking for some money donation, out of the goodness of your heart, you hand them a $10 bill, that is not a deductible, a tax deductible donation. They are not a qualified 501c3. They don't meet any of those qualifications. Right? So it has to be one of these types of organizations. There is a place on the IRS website where you can go and look up organizations to make sure that they are qualified. Okay? Let's see. So the amount of the deduction depends on the type of donated property and is subject to, again, AGI limitations. So it has to be in cash or other property of value. There are also strict documentation requirements for both types of contributions. There is no deduction for services rendered. A lot of people are confused by this. Oh, well, I donate 5 hours a week to my church. I go in and do the bookkeeping for them, and I'm a bookkeeper, and I usually charge $100 an hour for my services, so I should be able to deduct $500 a week for those services. No, you cannot deduct for the value of services. You never received the income in the first place. Like you didn't, if you had received income from the church, and then you paid tax on it, and then you turned around and donated the $500 back to them, then that would be a deduction for you. But the services themselves, because you were never taxed on the income in the first place, you don't get a deduction for it. So services do not give rise to taxable income to the taxpayer, so no deduction is permitted. Taxpayer who travels away from home overnight to attend a convention as a representative of a charitable organization can deduct the related transportation and travel expenses. So if you're paying out of pocket for things like, okay, so the bookkeeping services, I have to drive 20 miles each way when I go there. I can deduct the mileage, charitable mileage for that, but I don't get to deduct the value of my services. If the taxpayer incurs travel expenses as a volunteer, the expenses are deductible if they have significant duties throughout the course of the trip and no significant amount of personal recreation is attached to the trip. I don't define significant. I don't know what that is. So here's an example. Kathy, CPA, supports the Boys and Girls Club. Each year she compiles the monthly financial statements and prepares the Form 990, which is the nonprofit tax form that is filed for nonprofit organizations. She estimates that she spends 20 hours a year working for the Boys and Girls Club. Her normal rate is $100 an hour. So if she were to bill them for those 20 hours, she would get $2,000, right? However, she's got no income. She's not billing them. She's not receiving the funds. Because her donation is her services, she has recorded no income for the services. She receives no charitable contribution deduction. Now, if she did bill them and then paid tax on that $2,000 of income, but then turned around and donated the $2,000, then she would get a deduction for the $2,000. There has to be some corresponding income along with that. She is able to deduct out-of-pocket expenses that she pays. So travel would probably be it. I don't know if you wanted to document the paper that that the financial statements are printed on. That's a little bit excessive. But. Okay, so we know services not deductible, right? The value of your services that could be really abused if that was allowed, right? Oh yeah, I make usually it's worth $200 an hour for me to go and clean up the yard at my church. And that's, you can make up anything there. Okay, so there is a difference as well with regard to the type of property that is donated. Capital versus ordinary income property. This is a concept, again, that we are going to go through in much more detail in Chapter 7. Capital property is investments, so any type of investment, or any type of personal property, personal use property, I should say. Okay, my car, for example, is personal use property. I have some stocks. And I get income from that. That's capital property, right? It's an investment. So anything used for investments or for personal use is one classification. And then we've got what's called ordinary income property. Whoops. Ordinary income property is things that would, if you collected on it, it would be taxed as ordinary income. So, for example, what they've got here Inventory and accounts receivable. So if we're in business and we sell items of inventory, when we sell them, the income that we receive is ordinary income. So, let's see, I'm just gonna put examples down here. Example, inventory or accounts receivable. Yes, people sell their accounts receivable. They'll have people that owe them money and aren't able to collect, and so they sell those accounts receivable to a collection agency, and that's how they get some money. Yeah.
So, you moved on, I apologize that I'm going backwards a little bit. So like, you can only deduct the mileage, but you can't deduct like the money that you spent in gas, and
You could do either one, you have a choice.
you can do either, not both?
Yeah, but not both.
Okay, and then that says 14 cents per mile. Do they put a cap on it, how much per mileage that you can
Yes,
deduct?
so for charitable, you'll find we have different reimbursement rates, mileage reimbursement rates depending upon the activity. So the business mileage rate, I think, is something like 65 cents a mile,
Okay.
if you're using it for business. Charity is like 14 cents a mile. We talked about medical as well. I can't remember what that was, it changed mid-year, like 18 cents, and then it went to 22 cents a mile. So there are different rates, but the IRS tells you what that rate is.
Okay.
Yep, and that assumes the gas cost in there if you're gonna use it. It's probably a lot easier to use the per mile rate, especially if you're talking about charity, unless you're doing a lot of charitable work. Okay. So, capital gain property, stocks, bonds, land, other investments, or personal property. Other types of donations are made with ordinary income property, inventory, accounts receivable. Essentially, it's if they were sold, how would the gain be taxed? Capital gain property has special tax rates as well, just like those qualified dividends. In fact, they're the same tax rates. Okay, ordinary or qualified dividends and capital gains, long-term capital gains, are taxed at the same tax rate. Okay, so they have a special tax rate. But essentially you distinguish between these two by determining if I sold it, how would that income be taxed, right? If capital gain property is donated to a public charity, the deductible donation is the property's fair market value, okay? So any of these, we're gonna use the fair market value. Whatever the value is today, right? If I were to sell it, what could I get for it? Now they say generally here because there is a difference depending upon how the charity uses the property that's donated. And this is that one exception. So, charitable contribution of personal tangible property. So there's an exception to that rule of fair market value. If the donated property is put to a use that is unrelated to the purpose or function of the charity's tax-exempt status. I think we've got an example down here. That's a lot of words. The contribution must be reduced by the amount of any long-term capital gain that would have been realized if the property had been sold at its fair market value at the time of contribution. We'll go through, I know it's a lot of words. We'll go through an example here. So, well, and they've got one here. So if a sculpture, which would be considered tangible personal property, so personal use property, tangible, you can feel it, touch it, smell it, hold it, that sort of thing. Sculpture is donated to a museum, okay? And it's put on display. That is a related purpose. Okay, so in that case, then you would use the fair market value of that statue. Okay, so let's say it's worth $2,000. You would probably want to have it appraised before you made the donation. Then you would get to have a $2,000 charitable donation deduction, because that's the fair market value of it. If, however, the museum sold the sculpture without displaying it, they use the funds for museum operations, that is an unrelated purpose and would require this exception. A second exception occurs if the investment property is short-term property, and we're gonna get more into that as well in chapter 7, short-term versus long-term property. Short-term is if you've held it for less than a year, or actually it's a year or less, I should say. The deduction is limited to the tax basis of the asset, which is also known as its cost, whatever you paid for it. It's also subject to some additional limitations depending upon who the organization is. So let's look at an example here. So Kemba donated his old computer to Helping Hands Industries. He had purchased it for personal use, this was personal use property, several years ago. It cost him $1,500. Well, it's personal use property, so we're gonna need to know the fair market value of it anyway. The computer's fair market value at the date of donation was $400. So let's look back here at this. So the contribution, so in this case, $1,500, must be reduced by the amount of any long-term capital gain that would have been realized if the property had been sold at its fair market value. So the computer's fair market value at the date of donation was $400. The computer is considered to be a capital asset, held more than 1 year, so he can deduct the $400 fair market value as a charitable contribution. Now, if the value of that had gone up, though, like it wasn't worth $1,500 anymore, now it was worth $1,900, then if he were to sell it, then he would have a gain of $400 on it. Your gain is always going to be what you sold it for minus what the cost is, okay? So that would be $400. In that case, we would have to go by these rules here. Contribution would be reduced by the amount of any long-term capital gain that would have been realized if it had been sold at its fair market value at the time of the contribution. So essentially what that does is it brings it back down to its cost. So the gain would have been $400. If it was worth, what did I say, $1,900. The gain, if he sold it, would be $400. We have to take the $1,900 and subtract the $400, so it brings it back down to its cost in most cases. Yeah.
So then instead of being able to deduct it, you would have to claim it as a gain?
No, you have to calculate the gain just to determine how much you have to reduce that deduction by, how much you have to bring that reduction amount down to.
So in this case, it would just be 1,100 then instead of 1,500, or?
So in this case, it's 400 because it was a loss. Like if he sold it, he'd have a loss. So it doesn't matter. It's going to be whatever the fair market value
So
is.
if it was worth 1,900 instead of the 15?
Yes, if it was worth 1,900 instead of the 15, then we would take the fair market value minus any gain that we would have recognized. So our gain that we would have recognized, so let's see, cost 1,500, fair market value is 1,900. So in this case, contribution, which would be the fair market value, we'll start with the fair market value here. We're going to reduce it by any amount of long-term capital gain. So our gain, which would be our fair market value minus cost, is our gain. In this case, 1,900 minus 1,500, $400. So we're going to take that 400, subtract it from the fair market value, and the donation value now is 1,500. So we don't get to take the fair market value in that case. We get to take the cost.
So if the fair market value is more than what you paid for it, you can only deduct the cost?
Yes, if it's long-term capital gain property, tangible capital gain property. Yes. This oftentimes, and only if it's being used for an unrelated purpose. You think about those, people donate cars, right? They'll donate their old car to some organization. Chances are the organization's not gonna use the car, they're gonna sell it, right? even if it's to a junkyard. They're gonna sell it to get some sort of residual value. Because it's not a related use, then what happens in those cases is the donor has to wait for the organization to send them, once they sell it, they'll send the donor a letter saying how much they got for it. And then the donor can use that in their calculation.
So what if they don't send you what they did with it by the time you have to file your taxes?
Well, you can go back and amend, chances are they would, because even if it's, you donated on December 31st, you don't have to file your taxes until April 15th, right? Or you could file an extension, but if they didn't, you could go back and amend the tax return after the fact, if you'd already filed it. And you've got 3 years to do that. But most organizations that do that, they've got a system set up. Do you have a question?
Maybe I'm like waiting to like see if you get to it first before
Oh, that's
I
okay,
ask.
go ahead and ask it.
So like, because we're talking about, just say capital property.
Mhm.
So like, let's say I bought land for $200,000. Its fair market value when I sold it was $150,000. And that, I gave it to the government or gave it to the city to like build a new park or something. And so what you're saying, like, is I can deduct that whole $150,000.
$150,000.
What if I didn't make that much?
Right, then we're gonna talk about some carryovers. Yeah.
Okay, so that would be a carryover.
Yep.
Okay.
Yep, and it's
I was
gonna be,
like-
also gonna be, limited to your adjusted gross income. Only a
Okay.
percentage of your adjusted gross income. But there are carryovers
Okay,
that you can use, so that you can apply it then to a year when you do have income.
got it. So just like normal income, like taxable income overall. Got it.
As long as you itemize your deduction. Remember.
Right.
So, but chances are, I mean, if you've made a $150,000 donation, then obviously that's gonna get you higher than your standard deduction amount in and of itself. When ordinary income property, such as inventory or accounts receivable, is donated, the deduction is limited to the tax basis of the property donated. So ordinarily, that would just be the cost, what they paid for it, the tax basis. But they say tax basis because sometimes these items have to be written down in value, and it changes their tax basis. But anyway, so it does not depend on this one does not depend on the type of recipient organization. Here's our limitation. Okay, so, and it changed, now be careful, because I think you've got a problem in your homework that is a little tricky because of you have to pay attention to when the donation was made, because you'll see here, the year it changed. Okay? Take a deep breath.
I'm just thinking like, cause if you deduct everything and then like your taxable income is 0 and you don't have to pay taxes, so would that mean that like your tax liability would be what you received as a refund?
So you would have, well, your tax liability would be 0, but if you paid, oh, you mean for the next year?
Yeah, so like let's say that I made $60,000 this year and all of that was deducted. So I would have a 0 tax liability, but because I'm a W-2 employee, I paid all of that money in.
Then you get a refund for the amounts that you
For the
paid.
entire amount. Okay.
Yep. Okay, so for 2021, taxpayers who itemized, again, were allowed 100% AGI deduction for their cash contributions. Be careful here, just the cash ones. Okay, so if you donated $150,000 in cash, you would get a deduction, itemized deduction for the whole $150,000. Now, again, as long as you have that income. For 2022, however, that is no longer in effect. Cash contributions now are subject to a 60% AGI limitation for the deduction. So if your AGI is so for, let's see, 2021, let's say your AGI is 150, and your charitable deduction, cash, was $100,000. Okay, so that brought your taxable income down to $50,000. In 2022, you still had AGI of $150,000. You still made that charitable contribution of $100,000, but now you are subject to 60% of your AGI. So now we've got to calculate. So even though we made a $100,000 donation, we only get to take 60% of this, which is, how much is that? It's 60%. $90. Now, we can only take 90,000. Okay, so it changed from one year to the next. Okay, there are 3 limitations concerning the charitable contributions. So 60% was a donation to, if it was a donation to a certain type of organization. There are 60%, so starting in 2022, there's a 60% rate, there's a 30%, and there's a 20%. This relates to the percentage of AGI. So again, we've got to know AGI. Not the percentage of the actual donation, but the percentage of AGI. Which means they're limiting you, you're not going to get down to 0. Again, just with charitable contributions. Okay? The excess of the limitation is carried forward for the next 5 years. So, we've got 10,000 here, that would go forward to 2023. And if we didn't make any other donations and we still had AGI, then we would be able to take that whole 10,000. But if we said, let's just say in 2023 now, we had a bad year. We only made, what would I do? So, 60, 30,000. So now our AGI limitation is going to be 30,000 times 0.6. 18,000. Well, that's our AGI limitation. If our deduction carry forward was 10,000, we'd be able to take all of that in this year. But if this amount, this 60% was less than the 10, then again, we would be limited to 60%. Okay, yeah.
So if in 2023, if you made more, so like you had another like charity you could deduct, would you take your carryover first and then take whatever of the current year, or would you take the current year first
so
and
the
then carry
ordering, so here the answer, that question is answered here. The deduction of amounts from previous years is done first, so it's first in, first out. Okay, so yes, we would include the 10,000 first. So if we had an additional 50,000, so our total was 60, and we had 30,000. Our limitation is 18,000, right? 60%. So we can take 18,000, 10,000 our carry forward we can take, right? We're left with the other 50,000, but we've got 8,000 that we can use. So we would subtract the 8,000 here. So we get to take 18,000, which is the combination of last year's and the amount that we can take from this year. And then what's going to happen with this? We have 42,000. Yep. That's going to go to 2024. Okay. Only for up to 5 years, though. You better use it within 5 years. That's why you get to take the first in, first out. They'll let you absorb that first. subject to the overall 20% limitation in those years. I'm sorry, 60% limitation in those years.
So does that mean that 42,000 is limited to the 4 years?
So you
Or
have
does
to.
it start over at 5
No,
years?
that would start over in 2023, because
Okay.
that's when you, yeah, because you absorbed that 10,000.
Got it.
That's gone out of the picture. But you can see how this could get complicated, where you're carrying forward all these different amounts and trying to figure out, okay, which one do we take first? And that's a percentage of our AGI, which is another reason. Well, actually, that's a reason to increase your AGI, right? To want your AGI to be higher, because it's gonna give you a higher deduction in this case, but that's not always the case, right? There are other credits where that AGI can you see where the tax planning comes in?
Yeah.
It's this giant puzzle trying to put it all together, right? Okay, so let's look at Doris. We've got several examples for Doris. Doris is a wealthy widow and has $200,000 in AGI from various investments. If she makes a $150,000 cash donation in 2022, okay, so we're limited to 60%, assuming no other donations, her charitable deduction would be 60% of her AGI, which is $120,000, but she donated $150,000. So she only gets to take $120,000. The other $30,000 is going to get carried forward to next year. Make sense? Okay. Now, that's 60%. That's cash property. There's a 30% limitation, which applies to contributions of long-term, tangible capital gain property. What would that be? So this is something that you've held for at least a year. Well, I'm sorry, more than a year. That's our cutoff between short-term and long-term, is 1 year. 1 year or less is short-term, more than 1 year is long-term, okay? Contributions of long-term, tangible, you can touch it, capital gain property. So investment land would be an example. When long-term tangible capital gain property is contributed to a public charity, the property is put to a related use, then the taxpayer can take a deduction for the asset's fair market value. So that's the related use. However, that deduction is limited to 30% of the AGI. Again, excess is carried forward 5 years. So let's go back to Doris. So she didn't give cash this time. Now she contributed a vacation cottage that she has owned for many years. The cottage is in marshland and can be used for research purposes. It has a fair market value of $150,000. The university uses the cottage as a research station for biology and zoology students, so that's a related use. They didn't sell it. They're not using it for, something else. It's a related use to what their purposes are. They didn't give it to the college president, that sort of thing. In this case, her deduction is going to be limited, though, to $60,000 for this year, because it's 30% property. 30% of $200,000. Okay? The excess now is $90,000. It's going to get carried forward for the next 5 years. Doris probably needs to, this is where, when you've got wealthy clients too, the planning is, okay, when are you going to make these contributions? And timing it with the right amount of income, right? All right. Now, the exception is the taxpayer can choose to reduce the fair market value of the contributed property by the long-term gain that would have been recognized if it had been sold at its fair market value. So now that other scenario that we talked about earlier, where we actually make a choice about it, that if we can choose to treat it as though it wasn't put to a related use. Okay? In this case, the 60% limitation applies rather than the 30% limitation. So I'll show you how this changes things here. Same facts. Okay. Doris, again, she's gonna make that election. She's gonna reduce the fair market value of the cottage by the amount of long-term, I'll tell you why you might wanna do this after I finish reading it. By the amount of long-term capital gain that she would have recognized if she had sold the cottage. Her adjusted basis or her cost in the cottage is $70,000. That means her gain would have been $130,000. Now wait a minute. If she chooses the other method, she's got a deduction of $150,000. If she chooses this method, she's got a deduction of $130,000. Why on earth would she want to do that? Her deduction is less, right? Well, she's going to have to carry forward any amount anyway, right? In the previous scenario, she only got 30% of that $150,000. In this scenario, she gets to take 60%. She's limited to 60% of her AGI of $200,000. So she gets to take more. Now, so her gain, let's see, she would have, instead of the, what was the limitation up here? $60,000 limitation up here. Now she has a $120,000 limitation. But the value of it is $130,000. So she only gets to carry forward $10,000. Whereas before she gets to carry forward $90,000. But she's good. So in the current year, if she has really high income in the current year, it may make sense to do that. And she's anticipating that, you know what, this was a one-off year. This income is not going to continue. And so I'm never gonna be able to use that other $90,000. So I might as well now take the $120,000 in the year that my tax rate is higher. It's gonna be more of a benefit to me. Okay, so that's why, even though you're giving up essentially $30,000 of charitable donation, if you're never gonna be able to use that $30,000, then it doesn't matter, right? Because you're limited to those 5 years. So you have to think strategically about it, about which is the best way to treat it. And that's where a tax preparer would come in, a tax planner would come in and do an analysis of both choices. Okay?
I apologize, can you write this out to where like, if her AGI is 200,000, if she would have sold it instead of donated it, it would have been 130,000? Is that what you're saying?
So we've got the two different scenarios. Scenario 1, scenario 2. Her AGI is the same in both scenarios. So 200,000. 200,000. In the first, my facts right here. So she is donating the cottage, $150,000. It's used for a related use, and she decides to go ahead and take that. Now, because of the nature of the property, she is limited to 30% of her AGI. So this is our deduction limit. So there's our deduction. And then so she can take 60,000 of the contribution is 150,000. She can take 60,000 of it. This is her carry forward. So now she has a $90,000 carry forward. Okay? If she's going to have income in future years, then it may make sense to do this. Right? If she's going to continue to have that high income in future years, it may make sense to do this. But if she says, no, that income's not going to continue, then she may choose to take the second option, which gives you, now in this case, the deduction, what the contribution amount is different. It is limited to, where is it here? We have to reduce the fair market value, 150,000, by her, where is she here? Adjusted basis. What am I doing here? Or by the long-term capital gain. So the fair market value, in this case, so our contribution has to be adjusted, 150,000. We're gonna reduce it by the long-term capital gain that she would have had. So if the cost of it is 70,000, she sells it for 150,000, she's gonna have an $80,000 gain, right? So we're gonna reduce it by the gain. So now her contribution has been adjusted to $70,000. But in this case, her deduction limit, is 60% of the 200,000. So her deduction limit is 120,000. So now she's gonna get to take 70,000 in deduction, which brings her down, what are we here? This was 60, so this cuts off, what is it, another $10,000 of income? So this would be, what's here, 140. Our limit here, contribution of 70. So 130. So it reduced her taxable income this year by making this choice. But she also has to forego any carry forward. Like this 90,000 is now, she can't use that anymore. But like I said, if she's not gonna have income in the future to absorb that anyway, then she might as well, yeah.
When it says her adjusted basis in the cottage is 70, is that just saying that's what she paid for it?
Okay, so adjusted basis, and we're gonna go into this more in chapter 7. Adjusted basis for tax purposes is going to be the cost minus any depreciation that has been taken. Now, this was personal use property, so she wouldn't have taken any depreciation on it. You don't get to depreciate personal use property.
Okay, so cost minus depreciation, but in this case, there's no depreciation?
Yeah.
Okay.
Yeah, so that probably is that's probably just what she paid for it. So she gets a higher donation this year by doing this, but she has to give up that carry forward in order to do it.
So because her limit's higher, she can deduct the whole thing instead of carrying forward.
Yes, well, she can deduct 70,000 of it. It reduces the amount of contribution.
Okay.
But in this year, it's a better tax deal for her. Okay, it's trade-off, right? But like I said, if she thinks she's never gonna be able to use that, take this.
Right, but then at that point, there would be nothing to carry forward, so then she wouldn't have to worry about it, right? Okay.
Right, yep. Let's see, so, okay, now, the same thing happens though if the university sells the property. So in this case, they're still using it for a related purpose in both of these scenarios. In this example, if the university sells the property, the deduction is limited to her adjusted basis in the cottage of $70,000. So again, it would be the same as here, because they chose to sell the property. Essentially, she gets a donation for whatever she paid for, whatever her adjusted basis is. But the 30% limit doesn't apply, the 60% limit does apply. So in this scenario, she'd end up with the same result as she did here, because the 60% is 120, her donation is 70,000, she gets to take all of it. But again, there's no carry forward. How you guys doing? All your heads are down.
There's a ton of exceptions.
Yes.
At
But the
least for
answer
this.
to every tax question is it depends.
Yeah.
It depends. Whoops. All right. So that 30% limitation also applies to any contribution, cash or property, to charities that are not 100% limitation charities. So there are particular types of charities that even if it's cash, you don't get to take 100. You're going to be limited to your AGI, a percentage of your AGI. War veterans organizations, fraternal orders, cemetery companies, and certain non-operating private foundations. Okay, those are 30%. So again, it's 30% of your AGI, not 30% of the contribution or the charitable contribution, but 30% of your AGI. Then we've got this other 20%. This refers to the donation of capital gain property to a private foundation. So, and if it's a private foundation, they'll let you know. Like you'll be aware that it's a private foundation. For cash given to private foundations, limited to 30% of AGI. Capital gain property given to the organization, 20% of AGI. So it depends on what type of property you're giving to that organization as well. This is your Congress at work. Special interests. Special interests. Also, there is no charitable deduction anymore for payment to an educational institution for which the taxpayer receives a preferential benefit. Used to be that, so this would happen with supporters of like Iowa State, Iowa. If you made a donation, I know at Iowa State, I don't know what the level was at Iowa, but at Iowa State, if you made a donation of $10,000, that would get you first in line for purchasing season tickets. So you still have to buy the season tickets, but you make the donation, then you're first in line to get those season tickets. So a lot of people would do that. This eliminated that because you were getting preferential treatment.
How did they keep track of that?
Well, the tax preparers know, and that year that happened, there were a lot of clients that we called and told them, look, this you still make that donation if you want, you still get that benefit, but it's not going to be deductible.
Well, I meant how did Iowa State keep track of that?
Iowa State will send out a notice to everybody who makes a donation, especially in that amount. They have to send, and they're required to by law, send out a letter. So it's a letter saying you donated this amount, you got this in exchange, or you got nothing in exchange. So, that would be part of the accounting department at nonprofit organizations, would be keeping track of those charitable contributions and sending out notices.
I just meant as far as the ticket booths go.
Oh, well.
Yeah, how would they know that I made a contribution of $10,000? Do I have to
they
bring
know.
my letter?
They know, they know, yeah. You'd be on their list of people who could.
So then the tax preparers then, do they have access to those kinds of lists of people then for that, or?
Well, we
is
would
this
just
on
know,
a-
in our office.
They would just tell you?
Well, in our office, you mean so that we could call them ahead of time? Or?
Yeah,
Well, in
would
our
you
office,
know?
we knew who those clients were that had made those donations. I mean, we were,
Based off.
we had maybe
previous
400
years, or-
clients, but yeah, previous
Okay.
years. Yep. You would just kind of know. Or you can use the software as well to look up, okay, I want to search up everybody who made a donation over a certain amount and filter it out and then see, okay, was it to ISU, was it?
So can you make a deduction if it's a charitable deduction and you don't receive a preferential?
Yes.
Okay.
Yes, yeah. It's just that you were getting something in exchange, and that's one of those no-nos. You can't get anything in exchange for or at least you have to reduce the amount of your charitable contribution by what the value of whatever you received. But in this case, they just said, doesn't count anymore, any of it. Even though the value of it was probably not $10,000. Yeah. That's the example. I'm not gonna go through her. Okay, documentation that is required. So the nonprofit organizations are the ones that have to provide the documentation. So they have to provide a summary receipt to donors. When a gift to a charitable organization is less than $250 in cash, the contributor has to keep a canceled check or a receipt from the organization or some other written record to substantiate the deduction. This does cause some problems when you're, and I'll go back to the church example, if you're just giving cash in the basket, you don't have any substantiation for that deduction, and so therefore you can't take that as a deduction. If you write a check though, and you have a copy of that canceled check, then that's your substantiation. Or if you're doing it through automatic, a lot of churches have automatic contributions, like it just automatically comes out every month or every week, that's substantiation as well. So if the donation is $250 or more, the taxpayer must have written acknowledgement from the organization stating the date and the amount of contribution, whether they received any goods or services as a result of the contribution, and a description and good faith estimate of the value of any goods and services that the taxpayer received. In this case, the canceled check is not enough. This is any single donation of $250 or more. If you made 10 donations of $50, then that wouldn't be required, but the canceled check or credit card receipt or whatever would be required, okay? If it's cash. We don't need to go through that. So taxpayers are not required to aggregate multiple contributions during the year for purposes of 250 aggregates. I just said that. So here we've got Adina donates $50 to her synagogue. In October, she made an additional $500 contribution to the temple building fund. She may document each weekly contribution with a canceled check, but in order to take the $500 contribution, she has to receive a written acknowledgement from the synagogue stating the date and the amount of the contribution and the fact that she received no goods or services from the temple as a result of the donation. Okay. So that $250, again, it's not in, if that $500 had been split up into $500 donations, then she wouldn't need that substantiation, but she would need the canceled checks. Oh, let's see here. Substantiation requirements are the same for non-cash gifts. Non-cash property valued at less than $250, you should obtain a receipt or letter from the charity showing the name of the charity, the date and location of the contribution, a description of the donated property. The charity is not required to value the donated property. The taxpayer should keep a record of the property's fair market value at the date of donation and how it was determined. Think about donations to like Goodwill or Salvation Army, right? When you go, has anybody ever donated to, you know, you go and clean out your closet and you go and you get your receipt from them. They tear off a paper. All they put on there is the date of the donation. It's up to the taxpayer to document what that donation was and what the value of the donation was. Okay. Non-cash gifts that are worth more than $500, then the taxpayer has to file. So you've got to have the substantiation here if the IRS ever comes knocking. If it's $500 or more, then there's an additional form that needs to be filled out, and it's this 8283. I believe you have one of these to fill out in your tax return problem. I think it is, or somewhere along the line. So, donated property of, and there are a couple sections here, donated property of $500 or less and publicly traded securities fills this out. Name of the organization. If it's a vehicle, then you've got to put the VIN number in. Description and condition of donated property, so usually it's like, you know, if it's to a thrift store, household goods, good condition, that sort of thing. And then down here, so whatever's on line A up here corresponds to line A here, and so on and so forth. Date of the contribution, date acquired by the donor, usually if it's something from like a Goodwill type of donation, you just put various, right? Because it's a bunch of different stuff that you got at different times. How it was acquired, purchase, gift, you know, different ways of acquiring. The donor's cost or adjusted basis, fair market value, and what method did you use to determine the fair market value? Did you get an appraisal? if you're donating clothes, stuff like that to Goodwill, Salvation Army, usually just say thrift store value. And there's actually a list that the organizations will give you that will tell you how much things are worth. And that can be used for individuals who are, it's kind of a record-keeping nightmare, especially if you're donating a bunch of little stuff, but, and then more, if it's property over 5,000, then you fill out part 1 down here. Information on the donated part. So see, there's all types of different stuff you can donate. Art, equipment, real estate, securities, collectibles, vehicles, all sorts of different stuff that can be donated. All right? So you'll probably, when you're doing your homework, you're probably going to need to reference this information in the book to remember which way it goes. Because that's a lot of